Hey, good morning, fellas. Ken at Tortoise Capital. This is Foundations check-in for November 12th, 2023. Just went through the intros. Um, we were talking about patience and learning to sit on your hands and not taking shortcuts. One of the maybe the best technique I ever learned, stumbled into it really for this, was practice being well prepared. So well planned, well prepared, in the zero state. The prices have aligned correctly for you. The market, the sector, and the target are all leaning towards yes. And there's your perfect exit or your perfect entry. And then don't take it intentionally. Let that one go. And then watch it succeed. It's really important that then becomes a trade that works perfectly according to the setup that you had. And you're watching it work without you in it, and just fully feel all of those feelings. And when you can do that with laughter and let that one go, knowing that there's a million more coming, when you can let the perfect trade go, when you can learn to say no just for no reason at all, look how much easier it's going to be to say no when you have a reason. And your reasons for saying no include, it hasn't met all my criteria. I have to relax a constraint. I have to change a rule. I have to override my trading plan. Right? All of those are reasons to say no to a trade. But it takes an act of will to do that. I mean, there's a certain cost. So say I felt the urge to trade it, and I could trade it if I just violated this one little rule, but I decided I'm not going to do it. That was a test of your internal guidance system. And take a look at your psychic emotional bank account when that happens. Did that cost you energy? Or did your reflection upon that moment strengthen your resolve to do better? So I'm really, I'm happy when you decide not to take the trade. But what I really want to know is, what was the net result of your emotional equity line, right? What I want to see is the correct decision adding to your equity. So there I am. That's how much energy I have in my emotional bank account, my professional emotional bank account. And now here comes a little event on this trade frame. And that little monkey says, "Aha, we could take that trade if we violated our rule." And then you run it through your emergency reaction system, I guess. What you have is, you have this wedge between impulse and action, and you're going to make a judgment because you also know that this little monkey that's giving you these impulses is also the source of all your creativity and inspiration and your unique advantage in the world, which is going to lead to positive R if we can harness that energy and do something proper with it. It's going to lead to R. And the truth is that those little creative impulses occur whenever they're going to occur. You can't schedule those. You can schedule a session in which we hope creativity could occur more. We've actually learned that you can do that. But the creative impulse that comes from the world and the situation, and this monkey is looking at it through this little lens, through his special monkey glasses, and he sees something in the world. He says, "Aha," and then he tells you about it. That creates that impulse to act. So you've got that little barrier that is a wedge in between the impulse to act and action in the market. Well, here you are, that you're well prepared, you're well planned, well prepared, and now you're into execution. And you see that frame, you're stalking it, it's getting close, and then it's stalling. It's not quite ready yet. And the monkey says, dude, go for it. So what do? Well, you have that barrier there, so you don't act on it right away. But what you do is you act on it by thinking about it, and you wonder, is this a time that I'm going to bend the rule, violate the rule, take it at a prototype level of action, or just note it in my trading journal for study later on to back test to see if how often this occurs. Maybe it's the first time I've ever heard that. Maybe it's the 25th time that the monkey has said that. And maybe it happens so often that I actually went and studied it, and it's looking like it could be a pretty good idea, but I haven't fully tested it out yet. Maybe that one is harder to say, nah, what the hell, I'll just go for it at a prototype level. So you end up making a decision to act, and then you take responsibility for whatever the consequent responsibility. You take responsibility for whatever the results of that decision are. Maybe the decision was not to trade and it goes on to win. The cost of that is regret. Could be. If you hold on to it, it's a real cost. If you notice the regret and then let it go, that could actually be an increase in your emotional bank account because you properly processed a feeling of regret. And maybe the feeling of regret gives you the energy to complete your study to get a definitive answer on that situation. That's a positive use of regret. Hey, the monkey says, look, I've told you 24 times. 24 times I told you that little situation is a surefire winner, in his little monkey voice. 24 times I told you that. And I just told you the 25th time, and see, it went on to score, and you still haven't done anything about it. And so you have put it through your brain, and you thought about it and said, yeah, I actually regret deciding not to act on that particular trade frame, number 25, because that would have been an easy win. Well, the feeling of regret can't be controlled because that happens before you even think about it. That's the response of your subconscious and unconscious to all of the information that's in there. So you feel the regret. And then what do you do with the regret? You just say, well, first of all, I'm going to release it and offer that up to the world and say, that's a genuine feeling of regret I had here. I acknowledge it. I'm aware of it. I accept it. I acknowledge it. And what I'm going to do is then take the gift of that energy and then do something with it. What could I do with that energy? Well, I could turn it into a story that says I'm a piece of crap and a scaredy cat and never be a good trader because I'm looking at fortunes and not picking them up, and I'm not doing the right thing with my intuition. After all, I'm a skilled trader and I have intuitions, and I should learn to trust my inner guide. That's one story you could tell. Another story is to say, well, I now recognize that thing hit 25 times. I have enough evidence to investigate it and do my due diligence and then complete my study of it. Or I could just say, you know what? After seeing it 25 times, I have enough due diligence and data on this that I'm now prepared the next time I see it to trade it live with one share or at the prototype level. So with the energy, I could do a lot of things. Some of them are professional. Some of them are immature, unskilled. A novice would say, "Oh, I can't trade, and I'm no." Well, that's for the future to decide if you're a trader based on the professional actions you take. So the point is that there is going to be energy that comes out of the feelings as you think about things and respond to the initial trigger. That trigger to act is a certain amount of energy. You, instead of acting impulsively, you use that energy to go through a thought process to decide what to do with the impulse in this moment. Do I trade? Do I not trade? If I trade, how much do I trade and under what circumstances? And then, whatever that decision is, you have the responsibility for the results. And you're also going to, as you reflect on that decision that you happen to make and the results that occurred, you're going to have a feeling. You should have a feeling about the decision you made. And you should have a separate reflection on the results, because we've got to learn to separate the particular decision and the particular results. And we got to say, look, like poker, it was a proper play to make the bet. The result was that I lost money, but the bet was proper and I played correctly. And I played at a level of risk that was correct. And then the results just happened to be a losing hand. You want that separate reflection on the process and the outcome. The outcome is data that you're going to use over a large data set of actual results, because what you're going to do with that is compare it to the due diligence results and your back testing, and you're going to say, are my actual results in the world similar to my due diligence? Or said another way, is my due diligence a good predictor of the shape of the results in the real world? If they're not, then your due diligence isn't good. It needs to get better. But if your due diligence predicts the shape of a histogram of results, and then you take that rule set out into the world and you get those results over a statistically large sample, and you say, yeah, you know what? The results in the world are actually a little bit better, or the results in the world are a little bit worse. Well, what is the difference? What's the deviation between the due diligence? If this curve in the middle is, I should make that blue. If the curve in the middle is my due diligence and the results are better, that's information and I can do something with it. I would actually like to understand why the results in the real world are better than my due diligence. Because if they're that much better over a large data set, again, my due diligence is incomplete, because there's some variable in there, some performance measure that I'm not capturing in my due diligence, and that's preventing me from getting an accurate estimate of the potential gains. So I might be saying no to systems that might actually be worth trading if my due diligence is underestimating the returns. That's a good problem to have. If you're going to have a problem, let's have that problem. But if the results in the world are in the red curve are worse than my due diligence, that's bad, because now there's confounding factors. There's variables that are leading to underperformance that I'm not accounting for. Maybe the spreads and the friction and my exit strategy or whatever is not feasible. Or maybe there's something that I'm doing. It turns out when I examine my performance, maybe I'm still making decisions impulsively that are causing underperformance. So I got to find out what the difference is between my due diligence and the actual performance. The original point of all this, I'm now ready to get to, right? Because what I actually care about is this transaction in here. This this is a potential this transaction was a combination of I recognize the impulse to act, which I encourage from my monkey because my monkey is the source of my creativity, which leads to my long-term R. And I don't want to suppress that because I actually can't suppress it. And I don't want to suppress it. It's what connects me to all the herd animals, by the way. All the herd animals over there are monkeys. We think of herd animals like wildebeest or zebras that the lions are eating. No, the herd is a bunch of monkeys. So when I encourage my monkey to sound off, to give me his impulses, what that is doing is reinforcing my connection to the psychology of the herd. I want to be a member and associated with that herd, but I want to be an outlier in that herd. I want to be one of those few monkeys that actually has a much stronger than average resistance to impulsive action. I want to be one of those few super monkeys. That way, I benefit from all of the feelings of the herd, but I have this extra power that inoculates me from impulsive action. So I have to encourage the monkey to give me those impulses so I can stay connected to all the impulsive monkeys so that I can learn to check and identify compound critical states when the impulsive monkeys are most likely to act in an impulsive way out of emotional response. So that actually helps me identify critical states. But this little wedge prevents me from acting impulsively directly in the market. What it does is I take the energy of that impulse and I just use that to fuel the professional decision cycle that says what to do with it. Sometimes I act on it and trade on it. Why? Because I've seen it 25 times and I'm ready to trade it at an appropriate level of risk because now I have this other part, this little risk manager over here who tells me how much money is appropriate to put on it. My little trade architect and designer over here is evaluating the trade frame that the monkey suggested, and he subjects that to some due diligence, says, yeah, it turns out that's a frameable trade that you've never taken before, but you've seen it, and we could do that. And this guy says, okay, based on that, I'll give you enough money to trade one share. And this guy says, all right, trader, go trade one share and let's get on with this thing. So I converted the energy of the impulse to act into a professional response. So the trade goes off into execution, and now I'm going to assess this whole thing. As you reflect on your process, I want you then to look at the decision and the energy that it costs. And what I want you to do is say, as a result of that, my emotional bank account went up 1R, plus 1R. The fact that I resisted the urge to act impulsively, it turns out was a net positive because I channeled that into a professional decision cycle that was the right thing to do with the impulse that was offered by the monkey. Did what he was supposed to do. My chief of staff did what my security guard did what he's supposed to do. He keeps the monkey from taking over the wheel and just going for it with all the bananas that we have. And then my fireman, my architect and risk manager and my chief of staff decide, yep, we're going to trade that live with one share or whatever. And we allocate it and we go. There's a professional process for that: time, will, pattern, and money. In this case, the variable was the pattern. Is that a acceptable pattern to trade? Well, the brain trust got together and said, yeah, I'm going to trade it with one share as a prototype, and I'm going to accept the results. I'm going to trade it in a professional manner, and I'm going to evaluate the results of that one share live, and I'm going to put that into the bin of actual trade results. I could have said, no, we're not ready for that yet. I'm not ready to risk one share. I'm going to use the energy of that to go conduct my research and back test one more time and do whatever. And that's a positive thing, because the brain trust got together and said, we're not ready to trade it. I don't have the professional will. It doesn't feel right yet to trade it one share live. I agree. So use that energy to go put it into the research bin offline and study the results. And then when you're ready, you'll know that that pattern is now ready to go. It's not production level. So what we did was we used the energy of the monkey properly. So this decision cycle could lead to, nope, we're not going to trade it and we're not going to study it. We're just going to note it. We're going to record it in the journal. That could be the right thing, because you don't necessarily research every single impulse the first time that you get it. Well, maybe you do. I get 50 impulses to trade a day. I can't study them all. So I wait for that to build up, and I take note of it in my little trading journal. And when that thing comes around enough, it's worth investigating. How often does that actually occur? And then what are the results when it occurs? And I can go through that cycle. I'd like to actually be able to investigate that pretty quickly. This product Edge Rater that we worked on looked so good yesterday. I'm ready to say that's the way a smart guy could do it. I'll tell you more about that later. So what I really care about is this black hole of your decision making. I just want to cast some sunlight on that. I want to say, look, once you successfully stop that impulse from trading like an amateur, you bring it over into the decision, and then from that, you decide on how you're going to act. Note it in my journal, research it with back testing, trade it forward with paper, trade it forward with one share, and now what I have is I have that same positive trading activity in the real world of actual trading, and I just decide how much risk to put on it. Paper, one share, prototype, limited production, half size, and full production. So I have to get past the back testing, which informs this due diligence process, and I have to someday commit to forward testing with paper trading in public with an accountability partner, so that there's some risk to my reputation and my identity, or one share or prototype. So I have to do this in order to gain data for the actual. What I care about now finally is, as you assess you studied your plan, prepare, execute. You're studying the decision you made. Any time that you made a professional decision, which includes, hey, just write it in my journal and not backtest it, but at least I noticed it. That's a professional response, and you properly employed the energy that the monkey gave you in a professional way. If you do that, that's plus 1R. That's actually plus 5R, because that's the hardest thing to do. And if you backtest it, that's plus 1R. And if you paper trade it forward, that's plus 2R, because that takes courage. And trading one share live is plus one. You put the 1R, 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 and 1R. Every time that you make a professional use of the energy that comes from the impulse to act, you are increasing your emotional bank account. It makes it easier to do it the next time because you've already done it successfully and you rewarded yourself in some meaningful way for taking a professional action when the monkey said, hey, take the trade now. And if you elected not to take the trade and you saw it go on to victory, how did you respond to the result? Write that in your trading journal as you're noticing your emotional response to the trade not taken. And if you can be positive about that, say, I did the right thing, and I'm going to use the energy of the trade not taken, the monkey's castigating finger, his little hateful attack, if you can take that energy and convert that to plus 1 and say, I handled it by saying, look, monkey, thank you for the negative comment. I'm going to use that to fund my continued professionalism. Thank you for the energy. When you can do that, all of these little transactions are adding to your emotional bank account, your professional emotional bank account. That's one way to do it. Or you take a look at you go to the old traditional frame which says, oh, the monkey attacked me with this impulse to act and I resisted it at great emotional cost, painfully, and then I did the other thing. Oh, that cost me, that wore me out to resist the urge to act. Holy shit. If that's the mindset that you're in, then every time the monkey gives you an impulse to act and it's costing you and you're depleting your emotional bank account, the monkey's going to keep coming after you because he knows that when he gets you down to zero, he wins and now you're going to act impulsively. Buddy, that ain't going to happen. I refuse to let that happen. I am not letting the monkey I'm not letting the monkey frame have 51% of the power and me have 49%. No, sir. No, sir. Monkey, you do your job. You give me those impulses. I use that when I am successful at resisting that urge. I make that wall even thicker and better. I use that energy to make a professional decision. When I reflect on that, I say, this is me being professional, and I reward myself for that feeling of professionalism in some meaningful way. And that reinforces, and then I reward the monkey for doing his job. All I'm doing with this is laying this out as a value creation process, as an emotional energy process to reinforce doing the right things in an intentional way. You got to map out your entire cognitive emotional flow chart and put that on a single chart and say, that's my feedback loop. And this is how I know I'm getting stronger every day. Every day that I have a green dot or a plus mark on my my visible checklist, I can see that I'm doing the right thing. That's where professional will comes from. Time, will, pattern, and money. That's where the willpower comes from to do the right thing. The patterns, we have 50 of them. Money, that's the easiest thing to come up with. Money comes from the consequence of being able to leverage time, will, and patterns. If you can do it, so few people can do that, money will come and find you. Guaranteed. So don't even worry about that. And time, all you have is the time anyway. You decide how much time you're going to put into it. Now, are you using that time properly? Well, let's be professional about the use of our time. Going through this process in your when the market is closed is the proper use of your time. What do you think preparation means? Do you think preparation is just putting the numbers on the chart to be prepared for tomorrow's trade on the trade frame? Well, that's part of it. But preparation also means following through with your assessment and reinforcing your emotional bank account. So, in conclusion, what I want to say is when you resist the impulse to act, what does that do to your emotional bank account? When you handle it professionally, did your emotional bank account just get stronger? Or did that cost you 1 unit of R? Did that cost you an emotional dollar? Every time that you face an impulse, what's that? That impulse to act. There's also the impulse to blame, and there's the impulse of fear and the impulse of greed. Those things also lead to actions. And those are all coming from the monkey mind. And the emotion is the knee-jerk response to circumstances. And that comes from the learned behavior of the herd. And it's a herd of monkeys. So Ilker said, have the wrist box at least to the top of the dragon. He was using the standard R10, which was smaller, about 40 cents. Should I increase the size of volatility as it goes up like that? So there's two factors that I want to be really clear on, and I've been trying not successfully to do that. One of them has to do with the frame signal, and one of them has to do with risk compared to normal moves. This is part of the risk reward. This one is a specific measure. Now, I'm going to start with the frame signal. And I'm going to, as always, use the SSC, which says we start with a harsh winter, and you know how to measure that in all the different time frames and the different ways. There's different ways to classify something as a harsh winter. The most important criteria is it's unambiguous. That means you're satisfied that if you showed that to anybody in the tortoise trading community or the owl group or whatever, it's absolutely, that was a harsh winter by anybody's reasonable definition. Like you wouldn't even tolerate discussion that that was. And then the R10 peaks at some local level, and then it crosses, and then at some point it's going to cross the dragon. At some point in here, that little guy turns to the spring, and again, that's he turns to spring. And we know that with our PSARs, that thing is coming down. And after a harsh winter that has reversed this much, by that time, the PSAR normally, usually, always is going to be co-located with the upper skin of the dragon. And we know that when the RL10 finally gets through the PSAR, that the PSAR is going to, in the next bar, is going to flip, and then that thing, in theory, is going to go up at some. We'd love it to go up in a straight line. Why do we want to see the PSAR going up in that diagonal line just like that? Answer, because that means it's going up the maximum allowable acceleration factor. And sometimes the price action was so big that it's going up faster than the PSAR is legally allowed to go. That's a good problem to have. If that happens, it creates a decision problem which says, what do I do with the fact that my entry is here and yet the price is up here? And now I have all of this gain, and my stop was either still here or it was following the PSAR, or maybe it was whatever that execution risk was, maybe it's here. And maybe I just jumped it to no lose plus dinner for two. So the open question in our mind, this is the hardest part of the entire trade. It's the only one that's painful, is how soon can I get my risk out of here over a large number of trades that I feel satisfied with the trade-off decision. This is a trade-off decision about where to place the trade. But I would say is when you see the PSAR moving up in a straight line, mathematically it's because price is running away initially and it's going faster than the acceleration factor of the PSAR. If you make the acceleration factor of the PSAR too big, it prematurely times you out. You get a lot of choppy action, and then the PSAR is not helpful at all. If your acceleration factor is too slow, that means too many times these runaway moves are going to come back and you're going to give away too many gains because your PSAR was too slow to accelerate. And now you're giving back all of this stuff. So we're trying to find some happy medium between the Cinderella PSAR, between too much and too little acceleration. I'm satisfied that the 0.2, 0.14 is really good for everything. If you're still in the trade after 10 bars, that's going to be perfect. It's really the first 10 bars that are any issue. Fact. Now, the specific situation Ilker had was that the R10 was something like this. On the particular Apple, I think it may have been a short trade, but the idea is the same. So here's the situation where the R10 which is a statistical measure of average moves, right? So the R10 comes from this side of the equation. The frame signal said that when the PSAR flips and the R10 or the RL10 has moved through here after a harsh winter, the R10 amount of execution risk almost always has 2 to 3 R to get back to the previous fair value, which could have been the RL 270. It could have been the Bollinger Band mean. It could have been any measure of reasonable value just prior to the event that caused the harsh winter to drive the RL10 all the way down here. Some event occurred. It could have been news. It could have been a hiccup. It could have been the opening. It could have been some large pile of money committed to the short side. Like all of the buyers that drove it up to here disappeared, and now there's no buying pressure, and now they're all on the side of the short side, and all of that energy is pushing it down in a surprise move. So there's no way of knowing why it's going down, and we don't care why it's going down. It's just going down. But we know when the harsh winter occurs and it reverses and it gets across the dragon, that there's reasons to believe that this amount of risk can lead to reasonable 2 or 3 units of reward if the buyers come in and the sellers stop selling. Now, the price that tells us this is false, the price that invalidates it in this frame, is a violation of the low point of the RL10 where the PSAR first hit. That is the price that tells us that this frame is not working. That is the execution risk, not the R10. Now, this is just synergy. It is usually the case that the R10 is approximately that size or larger. It's actually better if it's larger, because that means on that frame, I'm going to set the R10 equal to 0.2 of a loss. And it just so happens if the trade frame signal gets me out here, then I'm only going to take less than a 0.2. But the trigger to get out had to do with the frame signal, which was the hypothesis of the trade. So instead of saying all that, let me just say the execution risk is the larger, is the, or the, no, the 0.2 loss is connected to the larger of the PSAR flip or the R10. You know, you're always going to get out when the PSAR is flipped. But the R10 could be larger, and then you took an even smaller position sizing loss. Because the R10 is connected to, that's 1/10 of the range stat. The range stat consists of the average range plus a frog box. In this case, this was the average range. This vertical red bar. That's the average range. And the frog box that you calculated, which was the standard deviation of the last 30 days of range, it turns out that it computes to that size. So you take the average range, and then you add this frog box to it, and that gives you the range stat. Now, the R10 is the range stat divided by 10. So here's a case, and I want to show, this is where it gets a little statistically there. If I had a series of very, very, very consistent ranges, then the average range is like that, and the standard deviation is very small. Check or hold. So the range stat in this case for the red is the same average range with a very small frog box. Check or hold. I could have the same symbol so that mathematically the average is the same size, but it has some that are just extraordinarily large and a bunch that are very, very small, and mathematically it comes out to the same average. But the standard deviation could be large. So the range stat on that one is the average plus one giant frog box. Now I have to compute the R10. The R10 is 1/10 of this. And it's small. The R10 on the second one is larger than that. And it's because the frog box, which tells you something about the variation of that. Now, this is why sideways quiet channel that has become a Z3 pinch is so damn good. If I had some symbol that it had some big run up and then the price decayed and it came back to some important support level, and the last little frame was a doji, and those 30 days, the individual range was small, I'm going to have this case. I'm going to have some average and the tiniest little frog box, and the R10 is going to be at its smallest, and the yellow zone, the doji, is so small that when I get my little mechanical entry breakout, and then suddenly some whoosh, maybe it's related to the same thing that caused this huge price move. Maybe it's some other news event. But the sideways, the Z3P that caused this to be the smallest possible mechanical entry, and then I get surprised into the biggest move. Now, the other one that's always good is if I had price action that was always large after a long period of time, and now the volatility is double plus big. And then tomorrow it opens right here. And I can take, now I'm going to take the R10 box over here, because now I have all this change in the R10 is bigger, but it's still only 1/10. I can now put that little risk box at the open, and this might just be another day of big moves that way, or it might be a big move that way because all of the buyers are gone and now they're on the short side. So this is the case when the symbol is in play, and this is when it's super quiet. So in terms of volatility, what I want is when I array the last 30 days or last periods, and that's the average volatility, I want the things that are abnormally quiet, and I want the things that are abnormally volatile, and I'm not going to spend time in the middle section because that's normal volatility. I want there to be a special case of things that are either wildly in play, like the symbol AI last week and Chevron or CVS Pharmacy, or things that are quietly, this is what IYR is. That's the essence of sniper trading. So I say all that simply to say that this analysis that tells me about the size of the range stat and the frog box and the R10 has to do with the statistical behavior of the size of the daily range over the last 30 days. It is a adaptable measuring stick about the size and calibration of normal and abnormal moves. It has nothing to do with the particular trade frame that you're trading, which is where you're going to get your signals. It simply helps us measure how big the moves could be and how much risk we ought to be taking. So the stats covers the things like the R10, the R6, the R3, the frog box, the average win, or the average range, and then the range stat. Those are all the statistical measures. On the other side is the trade frame, which gives us specific price actions and measurements. Like, hey, it's the PSAR. It's the PSAR flip. And I mentioned that last week, why I think that's the most important measure.
Ken, is it fair to say that you want your initial stop to be where you're wrong based on the trade frame, but
I
that
would actually rather than saying I'm wrong, I'm not wrong because I took the trade in the direction I'm supposed to according to the rules. I am right. The price action invalidated the hypothesis. And so I got out.
yeah,
I'm right again.
I like that better.
And it's even better because you then get to give your monkey ammunition to say, "Hey monkey, I lost money again." And then the monkey will respond the way the monkey always responds. How does the monkey reliably respond? Make a prediction. Is the monkey suddenly going to become wise and say, well, philosophically, that was the correct play? No, he's a goddamn monkey. He's going to say, you just threw away my banana on that? Really? You dummy? That is so reliably predictable. That's how I know that my monkey is calibrated. The minute that I do not feel the urge to say, hey, dummy, you lost a banana again, then I know something is my monkey's getting complacent. And I am putting too much emphasis on the rational analytical side of my brain. The minute that it stops bothering me, I got a problem. I would much rather have the problem of suffering the feeling of pain from losing a banana and then processing it in a professional way, which adds to my emotional bank account. Now, that says a lot about how my brain is wired. I'm driven by guilt, judgment, shame, sarcasm, hatred of losing, all of that. I fully embrace all of that. That's my inner monkey. That's how I stay connected to the herd. But I'm also a guy who has a thick skin like a rhinoceros, and that little monkey can hit me with his stick all day, and it won't hit any vital organs. In fact, every time he hits me, I build up a little more callus, and I hurt even less. I feel it, I hear it, but it's like the sound of a drum being played, and I like the sound of drumming. That's simply when the monkey's yelling at me, all I can hear is monkey drumming, and I can just feel the rhythm, and I like it. Makes me feel good. So go ahead, monkey, do your thing, because I feed on that. Yeah. That is a emotional reframe that I invite you to explore and compare that to whatever your process is for handling emotion before, during, and after the trade. Your assessment plan must account for all of those, and your trading journal includes your emotional journey, in addition to your technical journey of managing money and all that other stuff. So, Ilker, have I cleared that up about the R10 versus the PSAR flip?
Yes, very clear, sir, and very helpful for the emotions. I need to learn, as I said before,
Yeah, we
to
all do.
manage my emotions better.
We,
Yeah.
we all do. That's you. Your emotions are a bucket, and there's either water in it or nothing in it.
Oh,
And
it's
if you
full.
don't have, yeah, so you got to go to the emotional well and pull that water up in order to sustain yourself. If your emotions ever ran dry, then I'm worried.
Yeah.
I
Now,
know
Ken,
what's to do with the emotions. The lack of emotions is what is truly psychotic and sociopath. We don't want that. There was another question out there. Go ahead.
Ken, you're taking the PSAR flip and setting that as your. I like that reframe, by the way, because I'm doing exactly the opposite of what you pointed out. But so you would use the PSAR flip as your initial risk.
As
That
the execution risk.
as the execution
Yep.
risk. And then it may line up with a statistical parameter such as the R10 or a frog
Yeah.
box, but you're using those statistical parameters kind of as a reference to the PSAR flip to see
Right.
if it's how it's lining up and how it's comparing.
Yeah. The width of the PSAR flip was the difference between the downward trend. Price was going down in the harsh winter, and then it started going up. And when it went up enough and the trend flipped according to the rules of the PSAR flipped. So now you can officially say, by your chosen definition, the trend has changed to the upside. Well, how big is the decision box? What is the buffer? Well, the buffer, the yellow zone, the noise, the uncertainty is this one. It's in the noise if it's in the noise box if price has moved. Now you're negative, you're lower than the entry, but you have not hit the exit signal. So here's what we're going to do is we're just going to encase that in a soundproof box. There is no information value coming out of that box. Nothing. Nothing that happens inside this box predicts anything. It doesn't invalidate this trade frame until price goes below there, which triggers the collapsing dragon. We have no information and we're just waiting. There's only one decision that we make once we've made that entry. Once we make that entry, the only decision we have is when to move the stop to no lose plus dinner for two. That's a decision we make according to the rule that you pick or a sniper override. When you decide, you know what, my chosen rule is obsolete because this thing has moved up farther than my rule makes me comfortable. Maybe my rule says that my stop should be here, and I don't feel professional giving back all that. Why? Because maybe my average win is here. Maybe my average win is here, and this thing is an above average win, and if I let it come back to here, I'm going to have a below average win. I don't want that to happen, so I'm going to move my stop to here so that my above average win is at least an average win. When that feeling, when that professional judgment of your sniper says it's more important to lock in that average win and reduce the amount of flexibility that I gave it, that's more important. It's more important to lock in that extra little piece and then give it temporarily less room. Then your sniper can override your rule. The only direction that the sniper can override your rule is to keep more of a winning trade. That's a good problem to have because now you're getting paid to go study your sniper feelings and decision making. You're getting paid sniper money to study your sniper decisions. So the PSAR flip defines the execution risk. And we're going to compare that to these other statistical measures to decide how. This is the one that tells you how much money to put on it. Because what if my execution risk was here, but my R10 was here? What I'm going to do is pick the R10 and say that is a 0.2 position sizing risk loss. And I'm going to multiply that by 5 to decide what my 1R position sizing risk loss is. That's the one that's going to help our equity curve grow smoothly and keep us from blowing up the account.
Can I jump in on
Let me make one final point. But we're going to study the execution risk based on the trade frame so that we can evaluate the histogram of trade results and R capture so that we can determine how confident should we be about all these different little patterns that we're trying. We're going to use the R capture independent of the money to evaluate the quality of the trade frame. We use the quality of the trade frame to help us decide which one deserves more money. And then on the specific trade frame, we know that sometimes the PSAR flip is so small that it's less than the R10 box. Now, what do you do in the case where the R10, oh man, this was using the, oh, that was the drawings inside of this bastard. Erase all drawings. I don't know. Anyway, if the PSAR flip was here, and yeah, and now the R10 is smaller, you use the wider box as 0.2 of your position sizing risk. Ignore the R10 if it's smaller than the PSAR flip. If the if the R10 box is bigger than the PSAR flip, then use this one for 0.2 position sizing risk. But you still execute off of the PSAR flip. Okay? All right. That's what I want to say. I didn't mean to interrupt, but I wanted to complete that thought. Hamad, what was your question?
Yeah. Sorry, I had my camera on because I'm in the middle of dinner. Sorry, my camera off. But my question is, in situations where your risk box is larger than the PSAR flip, so your initial stop is less than an R1.
Yep.
Would you engage the 2R battle drill at entry minus actual stop loss, or would it?
I would take the execution risk. So whatever the PSAR flip is, whatever that PSAR flip is, and you said what, the R10 was bigger?
Yes.
So I'm going to draw that in purple. Now, that is the best problem to have.
Absolutely.
Right? Because if that's my R10, and if this was the low of the day, like if that was the low of the day, then I have 10 of these, I have 10 of those bigger boxes all the way up. But where I'm going to invoke the 2R battle drill has to do with the trade frame. So I'm going to go 1, 2, and that's where I could add my second position.
Just to clarify that with numbers, let's say your R10 is $100, and then
the R10 is dollars per share. So
yes,
if something had if there was an R10 of $100, then that means his range stat was 1,000, and that means that the average range from low of the day to the high of the day was $1,000.
yeah,
Nothing moves that big except Berkshire Hathaway, and nothing else. So what you really mean is, remember, your R10, all of these statistics are dollars per share, per one share. So let's say the R10 was $2.
okay.
That means the range stat was 20. Even that is really large. It takes something like Google or Tesla that much, because right now Tesla's R10 is about $1.50, right? So it could. So let's call it 10. Let's say it was $10. What is that right? Wait a minute. No, R10 is $2, and the range stat was 20. Your PSAR flip might be $1, right? Because this
So your 2R battle drill is at a $2 profit per share.
At $2 profit per share.
Not
right.
$4 in this case.
Now,
okay.
Depending on the quality of the trade frame, I then have a separate decision of how much money am I going to risk on that whole trade. So how much money I'm going to risk? $1, $10, 25, 50, 100. So you have to go, that's where you go up that stack of $1 at risk, 1 share, prototype, limited rate production, full production. So in this case, if it was at full rate production, and that for me meant $100, then I could put $100 of risk capital on $2. Then I could have 50 shares. So that's on the risk side. Where I put the second position on is when the 1R execution risk was here, and I'm going to put that second position on when I get 2 execution risk. You're going to like that a lot, because you're executing here and you're only losing $1 of, when you took that full execution risk lost, you lost $50 and you risked 100 on the trade. In terms of position sizing risk, it was only a 0.5 loss. So, dude, I love that. I'm never going to, my monkey tries to throw a stone at me. Dude, you don't know how much risk I avoided on that one through discipline. So what I really want in the world are tight PSAR flips that featured this kind of big move and then a slow decay. You know what does this? Super pinch. A super pinch does that. Another one that's just as good is the damn Godzilla. The Godzilla is a special case where it's oversold on the 150-day, 30-day, and 10-day, and it terminated in a tiny little doji. And that thing is ready to break large in either direction. And everybody who is going to sell sold, unless there's a new wave of selling, then a whole new crew of people are panic selling, or it's going to be a long grinding move to the top. So Godzilla is great. Super Pinch is great. Both of them feature the smallest possible PSAR flip box in the world. Now I got to figure out how to erase all of the, clear all drawing. I got to get rid of all of these drawings. Ah, nice. That was easier than I thought. I think I answered that one also. We keep the geometry the same. The geometry has to do with the PSARs and the flip box and the dragon and all that jazz. That architecture, that geometry is the specific frame of the trade. You adjust your position size based on all those other statistical measures of how many dollars do you decide to risk. Separate decision. Mark asked, it should be the same thing. When you go from the 3-minute to the 30-minute, Mark went from the 3-minute to the 30-minute. On the 3-minute, it is normal that you can use the R10 because of the size of the average bar is small, and the R10 is usually slightly bigger than the average bar. But on the 30-minute bar, they're much bigger than the R10. So you're still using the same pattern. On the 3-minute bar, the R10 might be that big. On the 30-minute bar, based on relative size, it may only be that big. The signal that tells you that this is over is that line. So you got long here, and now it's moving up. And if you're on the 30-minute bar, that R10 exit may be right here. So it gets you out in the noise. So all you have to do is say, look, whatever the size of this is, that's going to be my risk box. That might be a frog box, which could be 3 or 4 times an R10. It could be a stack of a bunch of R10s equals 1 frog box. So that might be the size. If that's the low of the day, you still know that the maximum reasonable intraday move is the range stat. And under normal conditions, you could have 3 or 4 frog boxes. So if this turned out to be a frog box of size, you're still going to have 2 units of reward available to you. So you just have to use the wider stop. That also means your position size is going to be smaller, because the amount of adverse price action you have to tolerate is larger. That means your position size is going to be smaller. That's good, because now you have less dollars at risk per trade. And because you have 30 minutes to make your decision, you can actually put on and manage 5 trades on 30 minutes for span of control, whereas on the 3-minute, you might only be able to manage 1, but it represents a larger pool of your capital of risk. So one of the advantages of going to the 30-minute bar is that you have more positions, less dollar risk per position, and you have 30 minutes to make those decisions instead of 3 minutes. So this has to do with span of control. So when I'm trading turbo intraday, I might have between 1 and 3 open positions, but I could have 20 to 30 and it still has to be a good trade frame to get started, but it takes a long time. It could take 4 or 5 hours for that move to unfold during the day. It might take 20 minutes for the 3-minute bar to unfold and make its little quick move. So in the time, so if I put 20, imagine I put 20 trades on in the 30-minute bar at this moment, and then on this moment, I have 1 3-minute trade. I'm not even going to get a decision on these until here, when the bar closes. Unless it hit the stop, then it's out, and then I didn't have to make that decision because I put the stop in. So whether I'm watching it or not, the exit can be hit. But I got 30 minutes before I even have to look at those again. So when do I look at those? About 3 minutes before the bar closes. So at the 27th minute, I pull those up and to see how are they going to close? Is there anything in there that's interesting? Do I need to raise a stop? Do I need to add a second position pretty soon? So I can stalk those in that last 3 minutes. And then I got this little 3-minute guy. I got about 9 decision points. Every 3 minutes, I got to make that decision about the 3-minute bar. So I'm managing this thing in the middle, and I'm hitting the 30-minute guys at the end points. And so I just move in and out of the time frame. Check or hold. Does that make sense? So what I want to say is that this little trade strategy that you have here still works. You just got to realize that the 0.7R and the 0.5R and the 1R and 2R in hand, all of that is a function of how big your initial execution risk was, which was geared to the trade frame and not the R10. It's the trade frame that tells you when you're at 0.7, 1, and 2R in hand. And then so this is a fractal trade exit management strategy. Try saying that. And it's just the size of the box is different on the 3 minute. So you have a standard rule. It still works. It's just you got to adjust the size of your execution risk. And those were all the questions from today. Any open-ended questions yet?
May I ask something?
Yes, sir.
Yeah, for the 30-minute bars, at least for me, when I look at how you perform every night, the standard risk that you use is generally much smaller than a frog box, maybe twice the R10 or maybe three
It could
times
be.
the R10.
It could be, yeah.
And
I try to gear it to the size of the trade, and it just so happens on those things that I'm trading that even on the 30-minute bar, it's smaller than a frog box. It's bigger than an R10, smaller than a frog box typically. Yeah.
okay. And then one other question I had related to the first question I asked for the Apple one. When I adjusted the execution risk going forward for Kara 2 to the upside, generally the space between the actual price bar and the PSR is small.
Yep.
For Kara when it's grinding up
Yep.
slowly. And then any recommendations on, I generally get out when the price bar actually hits the PSR, but not
on exits,
yeah.
I would exit the PSAR when price hits it.
Okay, great, thank you.
And just be done with it. And the reason is it's probably early in the trade, and it's better to not think about it and just live with it and save your energy for being ready for the next decision. We shouldn't be worrying about that exit because we're already thinking about when do I re-enter and when do I reverse? Immediately or late, so I'm always managing the next decision to enter long or short. I don't want to spend a lot. I don't want to suffer. Do I get in? I just have a rule. And I would pick, we talked about, this is related to that same idea of when the PSAR is coming down and the R10 reversed, but it has not yet crossed the dragon. But the price
went up, -1%.
is running up fast, but the R10 is slow. So the R10 doesn't exit until this bar, and the price could already be up here. It could already be up here and falling, and you say, shit, heck, the R10 just crossed the PSAR, but the price is falling. What am I supposed to do? Well, here's what I do. Wait and see that price. Because if this just falls, okay, I'm not in. So what I like to do is I like to have, when I see that, and you're going to see that, by the way, for this thing it might have taken 10 bars to get down here. And if that thing is already up in the dragon in 2 bars and it's huge, then I would say on this bar, go to the bar -1, PSAR -1, and just say, if that thing gets that should be a green line. If that thing gets there, I'm just going to buy it.
Okay.
And then it stalls and it comes to here. And I say, all right, well, if it ever gets above that one, I'm going to buy it. And then it comes here and it goes up through here, and I buy it there. So that PSAR -1 gets you in. Now, if this thing was truly long enough, you're going to see that eventually the PSAR ends up coming down and matches the exiting of the dragon, and that just makes things simpler. Basically, when price is on the north side of the dragon, I want to be long. if price is on the south side of the dragon, I definitely want to be short. And that means every price that does this, I like getting short right there. That's the pocket entry short, because the last thing was this horrible harsh winter. The harsh winter is everything. It's the move that tells you it's in play. And when it couldn't even, and so that what that means is the dragon is actually the yellow zone. That's the indecision zone.
Yeah.
So if this thing fails before it ever even got into the yellow zone, buddy, I'm short. And by the same token, when it starts up in here, I'm stalking the entry as close to the PSAR flip as I can. And if the PSAR was like right on the other side of the dragon skin, guess what I'm doing? I'm buying a breakout of the dragon. And I just live with it. I just live with that decision. And then I know that the belly of the collapsing dragon is always a great short. So this is the only tricky zone. I just handle it. I trust my judgment more than I trust my rules. My rules say get in not later than PSAR -1 or RLXD. Get in not later than that. But if I made a judgment to get inside here, I just say, hey, that's my monkey sniper being aggressive. It all averages out at the end. As long as I am death on executing the collapsing dragon, then I just live with the consequences. So that's why I say I'm about 80% rules and about 20% sniper. And that's this decision in here, how to adjust that and how to get past thinking about it and just go with the instinct and just go and live with it, and then use my rules to protect me over the long run. Okay. All right, I have us at 10:45. Once again, we've consumed the creativity, but in this case, this is almost like creativity 202 in some sense, so it's worthwhile. And Chinlong and Joe both gave me permission to go for it. Okay. All right, that's everything I got.
Okay, thank you.
Any burning questions? Any residual burning questions? If not,
I've got one.
okay. Yes, sir.
So with regards to the PSAR flips, I noticed that sometimes you take the PSAR exit and sometimes you don't. I've been trying to use the 30 period moving average on the time frame that I'm trading to kind of guide me. You know, if the 30 period moving average is not too far away from the PSAR, then sometimes I'd consider kind of moving my stock to 30 period moving average rather than, you know, trail strictly of the PSAR. So I was wondering if you have some kind of
this
rule.
is my my penciled in rule right now. This is how I'm handling that. Let's see, let me try to draw this correctly. I should have drawn the PSAR in blue. When the trade is on its first leg, and then you get like the first pullback. I didn't draw that very well. Let me make this clear. So price is going up. The RL10 is working. And then you get a couple bars of pullback. And the PSAR in black is still pretty far out. right? Because it started with all that risk box first. This is where that Uwe exit, 1, 2, 3, on the fourth one jumps up to here, and then it might take the PSAR from that moment on, right? The other place you've seen me really working this hard is the skin of the dragon. So you got that thick skin of the dragon. This is what I've been doing. In the first leg, as long as the RL10 slope is up, I'm taking the PSAR. I can tolerate price going into the dragon in the first leg because I don't have that much in hand. What I do have is by the time this is happening, I've got the no lose plus dinner for 2 in, right? You see that? So on the first leg, I'm okay with the PSAR exit. And this is when you get there based on the Uwe exit. Or I might have just been using the PSAR altogether, in which case I'm still here. Check. Or I may have decided, like a sniper, just to move it to here until the PSAR picks it up, and now I'm on the PSAR. So in that case, what I did was I improved the R capture by an early no lose plus dinner for 2. And maybe it's because the first 2 bars were really big and then it started to drift. And I said, you know what? I just want to lock in that little bit. And I'm content with that until I see how it shakes out. So what I'm watching is this RL10. As soon as that thing flips over at the 12 o'clock position, I am now taking the upper skin of the dragon. So I am accelerating this to the edge of the dragon. So the reason I'm doing that is because in order to get the RL10 to roll over, there's 2 cases. It either had to be a significant one-time pullback, or it had to be a little decay, slowing down, and then more decay. So in both of these, there's energy to the downside. This was starting to fail, no new buying pressure. Like this is supposed to go up to here to keep that original energy, but it's not. It turns out that those 2 little weaknesses is enough to make the RL10 roll over, and then I've had enough, and now I've picked up the upper skin of the dragon. Now, sometimes you'll see price has moved up like this and starts to just slowly and starts to decay. And you'll see that the PSAR flip may have been something like this. Try to make sure I draw this right. Yeah, you might see that. And by that time, the dragon is going to be in here some goddamn where. Whatever the lowest one of those is, it just really is, hey, enough is enough. How much did I win? Is it an above average win? Maybe I'll just take it. I might take a 1, 2, 3. I might take the southern skin of the dragon. I might take the PSAR. I guess if the PSAR was inside the dragon, I might not take the PSAR. But normally the time you'll see me not taking it is when we're still on the first move and this hasn't reversed yet. And that's about all I can say. The one that I'm really starting to emphasize is that after I can see leg one and the R10 rolls over, take the edge of the dragon and don't wait for the PSAR. That's a case where I'm even accelerating faster than the PSAR. The only time I can think of when I haven't taken the PSAR is if for some reason from the peak and whatever that execution risk box was, I still haven't even given back one of those. But because this thing has gotten so quiet that the PSAR may have pulled up inside there. And I said, look, I haven't even given back one execution risk. That feels okay. Because if that's the case, then it doesn't take much reversal to flip the PSAR the other way, and then I'm back into it. So I just say, look, I'll give you one box. I'll give you one execution risk. That's about, if I am thinking about, that's probably the only time I'm doing that. There could have been, you could probably find one where that wasn't the case, but it was probably the case where the market was on a tear, the sector was on a tear, and this company was really, really good, and it had one momentary setback, and I was already 5 to 7R in hand. I was like, fuck it, let it run. Maybe that could have been a moment of weakness. The monkey won, but that's what I'm trying. 80% rule, 20% sniper. This is my most recent feeling of confidence that you will, every time you hear me say standard entry, R10 peaked, dragon skin exit, standard work. That's what it was like. Hey, leg one, and it hit and it rolled over, and it hit the dragon. I'm out, 0 state, and there's my re-entry on the emerging dragon. Done. That's when I'm gaining like the +1, +2, sometimes +3 win. When I'm getting those bigger wins, it's because leg one and the stall was not, it didn't even get out, and leg two started up, and then I either did or didn't get the second position, but it's already into leg two, and then I'm really going to preserve that. That's going to be probably a dragon skin exit too, but that's the one that really where I get the big wins. Is leg one doesn't hit the dragon skin, and it already is triggering a re-entry, or not a second position. You see that a lot. Okay. That answer your question? Okay. Anything else?
It's not a burning question, but any suggestion on how to structure the screen for multiple things? Yeah.
So here on the left side of my screen, which is a 40-inch monitor, I have the 30 symbols of the hybrid swing, plus a few more. And then over here on the middle third, middle half, I have thumbnails, SPY, EWZ, and XIV for volatility. Under here, I have a global index. It's usually EEM. On this one, I have IWM because I like the Russell small cap. And then I have, this is either FAS or FAZ, which is the triple leveraged finance ETF. And then I have um, um, like XLB. I will on the bottom row. Sometimes it's 3, sometimes it's 4. These are from the 30-minute um, um, portfolio, the ones that I'm stalking on the 30-minute stalk. It's like when I cycle through these, I can see which ones are getting close to a decision. And so I'll put those on when they're getting close. So that could be 6 other ones. And then in the final one, I have 3 larger ones, and these are on the 3-minute sniper trade of the day. So, let's see, where's my? I always need to see the market. I always have these 2 on because I'm ready to trade them instantly all the time on 3-minute bars. I have XIV on because that's usually the first thing that changes when the S&P comes into the station and gets quiet. And then I think there's going to be a pop. The first thing that happens is XIV, the volatility ETF, will start to move. And then that could lead to SPY moving, which could then lead to these volatile sectors moving. Sometimes they move before SPY does. So there is a relationship in here. As volatility becomes actual price movement. And then if I really want to trade the index, I'll make sure that DIA is one of these. Because that's the last one to move. So I can see the alerts and then follow through with a 10-cent risk box on the big fat DIA futures. Two pips. And then when DIA moves, dude, they are moving these large, heavy objects. And when does this start running out of gas? The S&P runs out of gas. XIV volatility changes. This starts to stall. Done. So you can actually engineer very tight stops on the DIA futures. You know, the mini Dow. And when you see the mini Dow starting to move, that's confirmation that the moves that are already underway in the US could have some real legs, because they're going to keep going as long as guys are buying DIA. It's going to hit the key leaders in there, and they're going to keep going as long as DIA is going up. They're probably going to keep going. So this screenshot allows me to see, and this is ranked by percent gain today, all the winners, all the big losers. When I see these start to reverse, bang, SSC. When I see these things starting to fail, time to harvest. And then if the market is up, I'm trading the leaders. If the market is going down, I'm trading the losers.
The losers, yeah.
So that one screen sees all of that. And then I have some other little message board over in here where the alert window says, hey, alert. So all of those little trade frames that have the triggers, bing, alert, and it just gives me that. And then I can use that to decide which ones to quickly look at and then which ones to hyper trade.
For the alerts, do you put in any stop or limit buy or sell orders, or you just look at this
Market.
chart and decide?
Market. If it's one of my usual suspects and it's a standard pattern, I just put a
Stop order.
stop order on. Yeah.
Okay.
And just get in and just eat it. Yeah. And that
Okay,
way,
great.
that way, you know, so if you get this kind of thing and now you have a Kata 2 shaping up, my second entry is going to be the emerging dragon. So and then maybe a 2-hour battle drill or a 4-hour battle. I just go ahead and put those in. And then micromanage the entry. And then if it goes up through here, bang, it's already in. And it keeps going, bang, it's already in. Then all I got to do is just keep putting my,
And it stops.
raising my stops that little bit. And then I have to get to no lose plus dinner for 2 on the first one, and then no lose plus dinner for 2 on the second one. And that's 95% of my trades. It is really rare for me to get 3 in. I'm just too cowardly. I just, it's too much. It feels like now they're stalking me,
Right. Yeah.
So, okay. Anything else?
Great. Thank
Good.
you very much.
Okay, fellas. Have a good rest of your weekend, and we shall see you shortly. 5-star reviews. Tell your friends. Take good care.